Welcome to AltFinance, the funding frontier, the podcast that brings you inside the evolving world of alternative financing. I'm your guide through this journey, Jason Feimster, founder and CEO of Moonshine Capital. In today's episode, we're diving deep into a topic that's pivotal for entrepreneurs and small business owners alike, lines of credit. This versatile financial tool can be the key to unlocking new growth opportunities and managing your business's cash flow effectively. Here at AltFinance, we're all about demystifying the complex world of finance and making it accessible. Whether you're just starting out or you're an experienced business owner, understanding the ins and outs of lines of credits can be a game changer for your financial strategy. So let's embark on this journey together, exploring what lines of credit are, their benefits, how to qualify for them, and much more. In this episode, we'll break down everything you need to know about lines of credit, from their basic definition to the nitty-gritty of managing them effectively. We'll hear real-world examples, insights into different industries, and look ahead at what the future holds for this dynamic financial tool. So whether you're tuning in from your office, your home, or on the go, I invite you to join me in unraveling the complexities of lines of credit. Let's empower ourselves with the knowledge to make informed and strategic financial decisions. The basics of lines of credit. Lines of credit stand as a cornerstone in the world of business financing, offering a blend of flexibility and accessibility that traditional loans often lack. To truly leverage their potential, it's essential to understand their fundamentals and how they operate. At its core, a line of credit is an arrangement between a lender and a borrower, where the lender provides access to a specific amount of funds that the borrower can use as needed. Unlike a loan that offers a lump sum, a line of credit is more like a pool of funds you can draw from up to a certain limit. You only pay interest on the amount you use, not on the entire credit line. Diving deeper, there are two primary types of lines of credit: secured and unsecured. Secured lines of credit are backed by assets like property or inventory. This collateral reduces the risk for the lender, often leading to lower interest rates for the borrower. Unsecured lines of credit, conversely, don't require any collateral but typically come with higher interest rates due to the increased risk for the lender. The distinction between lines of credit and traditional loans is stark. With a loan, you receive a fixed amount up front and repay it over a predetermined period, usually with a set monthly payment. A line of credit, on the other hand, offers ongoing access to funds, making it an excellent tool for managing fluctuating cash flow needs. It's particularly beneficial for businesses that experience seasonal sales variations or unexpected expenses. Consider a real-life example: a landscaping business that sees higher revenue during the summer months. A line of credit can provide the necessary funds to cover expenses during the off-season, with the flexibility to repay as revenue increases in the peak season. In summary, lines of credit offer a dynamic and adaptable financing option, ideal for businesses seeking a more fluid approach to managing their finances. They stand out for their flexibility in borrowing amounts and repayment schedules, adapting to the unique financial rhythms of your business. In our next segment, we'll delve into the myriad of benefits of using lines of credit, exploring how they can be a game changer for your business's financial strategy. The benefits of using lines of credit. So we've covered the basics of what lines of credit are and their types. Now let's dive into the benefits of using them, particularly for businesses looking for flexible financing options. One of the most significant advantages of a line of credit is the sheer flexibility it offers in terms of borrowing and repayment. Unlike a traditional loan where you receive and start paying interest on the full amount immediately, a line of credit allows you to draw exactly what you need when you need it. This means you're only paying interest on the amount you actually use. Let's take an example from a real business case. Imagine a retail store preparing for the holiday season. They need to stock up on inventory but don't have the cash on hand to make such a large purchase. A line of credit allows them to buy the inventory now and pay it back as they generate sales from that inventory. This kind of flexibility is crucial for businesses that have seasonal sales patterns or irregular cash flow. Another key benefit is the impact on cash flow management. For small businesses, cash flow is king. Having access to a line of credit can be a lifeline during periods of low revenue or when unexpected expenses arise. It provides a safety net, ensuring businesses can continue operations without disruption, even during lean times. To illustrate this, consider a small tech company facing unexpected server costs. A line of credit can provide the necessary funds to cover these expenses, allowing the company to maintain its operations and avoid costly downtime. This not only helps in managing cash flow, but also ensures that the business can continue to serve its customers effectively. Moreover, using a line of credit can also be a strategic move for businesses looking to capitalize on immediate opportunities. Whether it's taking advantage of a bulk discount from a supplier or investing in a sudden market opportunity, having immediate access to funds can be a competitive advantage. For instance, a real estate developer might use a line of credit to quickly purchase a property in an up and coming neighborhood. By having the ability to act fast, they can secure the property at a competitive price, potentially leading to significant returns on their investment. In summary, the benefits of using lines of credit are manifold. They offer flexibility in borrowing, help in managing cash flow effectively, and provide businesses with the agility to seize opportunities as they arise. This makes lines of credit an invaluable tool in the financial arsenal of any business. In our next segment, we will explore how businesses can qualify for a line of credit, diving into the criteria and requirements set by lenders. How to qualify for a line of credit. Having understood the benefits of lines of credit, it's crucial to know how to qualify for them. Whether you're a startup or established business, understanding the qualification criteria is key to accessing this form of financing. First and foremost, one of the primary factors that lenders consider is your credit score. A high credit score indicates to lenders that you're a low risk borrower, which can significantly increase your chances of approval. It's not just about having a good credit score, but also about maintaining a strong credit history, which includes your track record of repaying debts and managing credit accounts. But what exactly constitutes a good credit score? Generally, a score above 700 is considered good, but requirements can vary depending on the lender and the type of line of credit. For example, securing an unsecured line of credit might require a higher credit score compared to a secured one. Beyond the credit score, lenders also scrutinize your financial history and the health of your business. This includes examining your income statements, balance sheets, and cash flow projections. They want to see a stable and profitable business with a solid plan for the future. This is where having a well-organized financial records can play a pivotal role in your application process. Let's consider a real example. A small manufacturing company seeking a line of credit would need to provide detailed financial statements showing steady revenue and profitability. The lender would assess these documents to determine the company's ability to repay the borrowed amount. Another key aspect is the debt to income ratio. Lenders use this metric to evaluate whether you can afford to take on additional debt. A lower ratio indicates that you have a good balance between debt and income, making you a more attractive candidate for a line of credit. In addition to these financial factors, having a strong business plan can also enhance your application. A well thought out plan demonstrates to lenders that you have a clear vision for your business and understand how to use the line of credit effectively to achieve your goals. Improving your chances of approval for a line of credit also involves being proactive about your financial health. This might include strategies like reducing existing debt, increasing revenue streams, and continuously monitoring and improving your credit score. Remember, each lender has its own set of criteria, so it's important to research and choose a lender whose requirements align with your financial situation and business needs. In the next segment, we'll delve into the costs associated with lines of credit, including interest rates and fees, and how to navigate them. The cost of lines of credit. Understanding the cost associated with lines of credit is critical for any business considering this financing option. The cost is not just about the interest rate, It also includes various fees and charges that can impact the overall expense of the credit line. Firstly, let's talk about interest rates. These can vary widely based on factors like the type of line of credit, whether it's secured or unsecured, and the lender's policies. Generally, secured lines of credit have lower interest rates because the lender has collateral to fall back on in case of default. Unsecured lines, on the other hand, typically carry higher interest rates due to the increased risk for the lender. The interest rate on a line of credit is often variable, meaning it can fluctuate with market conditions. This is an important aspect to consider, as a rising interest rate could increase the cost of borrowing over time. To give an example, a business with a line of credit at a variable rate will need to be prepared for the possibility of increased payments if interest rates go up. In addition to interest rates, there are often other fees associated with lines of credit. These can include origination fees, annual fees, and transaction fees. For instance, some lenders charge a fee just to open the line of credit, while others might charge an annual maintenance fee, regardless of whether you use the credit line or not. It's also important to consider the cost benefit analysis of using a line of credit. This involves weighing the cost of the credit line against the potential benefits it brings to your business. For example, if the line of credit allows you to take on a project that significantly boosts your revenue, the cost of the interest and fees might be well justified. To put this into perspective, let's look at a real life case. A construction company might use a line of credit to purchase materials for a big project. The interest and fees on the credit line are an additional cost, but if the project leads to substantial profits, the overall financial benefit to the company can be substantial. Finally, it's crucial to compare different lines of credit to find the most cost effective option for your business. This means looking at not just the interest rates, but also the fees and terms offered by different lenders. Shopping around and negotiating terms can lead to significant savings. In our next segment, we will explore the risk and pitfalls associated with lines of credit and how to navigate them to avoid financial trouble. Risk and pitfalls. While lines of credit offer flexibility and can be a valuable financial tool for businesses, it's also important to be aware of the risks and pitfalls associated with them. Understanding these risks can help you manage your line of credit responsibly and avoid potential financial troubles. One of the primary risks of using a line of credit is the potential for overspending. The ease of accessing funds can sometimes lead to borrowing more than what is necessary or sustainable for the business. This can result in a debt spiral where a business finds itself constantly borrowing to cover previous debts, which can be a dangerous situation. For example, a retail business might use a line of credit to stock up on inventory. If the inventory doesn't sell as expected, the business could find itself unable to pay the borrowed amount, leading to increased debt and financial strain. The highlights the importance of borrowing within your means and having a clear plan for how to use and repay the funds. Another pitfall is the variable interest rate, which, as mentioned earlier, can fluctuate. This means that the cost of borrowing can increase, sometimes unexpectedly, which can impact your budget and cash flow. Businesses need to be prepared for these changes and have a plan to manage their finances should interest rates rise. Mismanagement of a line of credit can also have serious consequences on your credit score. Late payments or defaults on a line of credit can damage your credit history, making it more difficult and expensive to secure financing in the future. Let's consider the case of a small tech startup that took out a line of credit to cover operating expenses but struggled with cash flow due to delayed client payments. Their inability to meet the credit line repayments on time negatively impacted their credit score, making future borrowing more challenging and expensive. It is also essential to read and understand the terms and conditions of your line of credit. Some lines of credit might have clauses that are not immediately apparent, such as penalties for early repayment or changes in terms based on usage. Being aware of these terms can help you avoid unexpected costs or restrictions. Finally, relying too heavily on a line of credit can signal underlying issues in your business. such as poor cash flow management or inadequate revenue generation. It's important to use lines of credit as a part of a broader financial strategy rather than as the sole solution to financial challenges. In the next segment, we'll explore how lines of credit are used in different industries, providing a broader perspective on how this financial tool can be adapted to various business needs. Lines of credit in different industries. Lines of credit are not a one size fits all solution. Their application and benefits can vary greatly across different industries. Understanding how various sectors utilize lines of credit can provide valuable insights into their versatility and strategic use. In the retail industry, for example, lines of credit are often used to manage inventory. Retail businesses typically experience seasonal fluctuation in sales, and a line of credit can provide the necessary funds to stock up in anticipation of high demand periods. A clothing retailer might use a line of credit to purchase additional stock before the holiday season when sales are expected to peak. The construction industry presents another interesting use case. Construction companies often use lines of credit to finance the upfront cost of material and labor before receiving payment from clients. This is particularly useful in managing the cash flow challenges that arise from the long payment cycles common in this industry. In the tech sector, lines of credit can serve as a buffer for research and development costs. Tech companies, especially startups, often face significant upfront expenses before their products or services generate revenue. A line of credit can provide the necessary funds to continue development and cover operational costs during critical growth phase. Healthcare providers also benefit from lines of credit. Hospitals and clinics face unique financial challenges, such as the need to invest in expensive medical equipment and the delay in receiving payments from insurance companies. A line of credit can help smooth out these cash flow irregularities, ensuring that patient care remains uninterrupted. The hospitality industry, including hotels and restaurants, use lines of credit to manage seasonal variations in business. For instance, a hotel in a tourist destination might use a line of credit to refurbish rooms in the off season, preparing for the influx of guests during peak travel times. Agriculture is another sector where lines of credit play a crucial role. Farmers and agribusiness deal with seasonal cycles and unpredicted factors like weather and market prices. Lines of credit can provide the financial flexibility needed to manage these uncertainties, whether it's for purchasing seeds and equipment or bridging the gap between planting and harvest. These examples illustrate how lines of credit can be tailored to meet specific needs and challenges of different industries. By understanding the unique aspects of each sector, businesses can more effectively leverage lines of credit to support their goals and growth. In our final segment, we will look ahead to the future of lines of credit, discussing emerging trends and how technological advancements are shaping this dynamic financial tool. The future of lines of credit. As we near the end of our discussion on lines of credit, it's important to look ahead and consider how they might evolve in the future. The landscape of finance is constantly changing, and lines of credit are no exception. Emerging trends and technological advancements are shaping the way businesses and individuals access and use these financial tools. One significant trend is the increasing digitization of the financial sector. Fintech companies are revolutionizing the way lines of credit are offered and managed. Online platforms are making it quicker and easier for businesses to apply for and access credit lines. These platforms often use advanced algorithms to assess creditworthiness, potentially making lines of credit accessible to a broader range of businesses, including those that might have been overlooked by traditional banks. Another development is the rise of personalized and flexible financing solutions. Lenders are increasingly using data analytics to offer customized lines of credit that align more closely with the specific needs and cash flow patterns of businesses. This can mean more adaptable repayment terms or dynamic credit limits that adjust in response to the financial health and performance of the business. Sustainability and social responsibility are also becoming key considerations. We're seeing a growing number of financial products, including lines of credit, being linked to sustainability goals. Businesses that demonstrate a commitment to environmental and social governance, or ESG, principles may have access to more favorable credit terms. Blockchain technology and cryptocurrencies are also starting to impact the world of lines of credit. Although still in the early stages, blockchain offers the potential for more secure and transparent credit transactions. Cryptocurrency based credit lines are also emerging, offering new ways for businesses to leverage digital assets for financing. Looking ahead, we can expect lines of credit to become more integrated with other financial services, providing a mere seamless and efficient experience for borrowers. The future of lines of credit lies in their ability to adapt to the changing needs of businesses and the evolving landscape of the financial industry. In conclusion, lines of credit have proven to be a versatile and valuable financial tool for businesses across various industries. As we move forward, they will continue to play a crucial role in helping businesses manage cash flow, seize opportunities, and achieve growth in an increasingly dynamic economic environment. As we wrap up this insightful journey into the world of lines of credit, let's take a moment to reflect on the key insights and takeaways from today's discussion. We've navigated through the intricacies of lines of credit, understanding their flexibility, the strategic advantages they offer, and how they can be effectively integrated into your business's financial portfolio. We started by exploring the basics of lines of credit, distinguishing between secured and unsecured types, and how they differ from traditional loans. Their flexibility in borrowing and repayment emerged as a standout feature, offering businesses a more adaptable approach to managing finances. We then delved into the benefits of using lines of credit, highlighting their role in smoothing cash flow, providing a safety net for unexpected expenses, and enabling businesses to seize timely opportunities. The importance of maintaining a good credit score and strong financial history was underscored when we discussed how to qualify for these lines of credit. In discussing the costs associated with lines of credit, we emphasized the need to consider interest rates, fees, and the overall impact on your business's financial health. We also addressed the potential risks and pitfalls, stressing the importance of responsible management to avoid overextending your finances. We saw how lines of credit are uniquely leveraged across different industries, from retail to construction, tech to healthcare, each adapting this financial tool to their specific needs and challenges. Finally, we looked ahead to the future of lines of credit, anticipating further innovations and adaptability in response to evolving market trends and technological advancements. Remember, whether you're exploring lines of credit for the first time or looking to optimize your existing financial strategies, it's all about informed decision making and strategic planning. Lines of credit can be a powerful ally in your business's growth and success, but like any financial tool, they require understanding and careful management. Thank you for joining me on this episode of AltFinance, the funding frontier. I hope you found it enlightening and empowering, giving you the confidence to explore and utilize lines of credit in your financial journey. If you're seeking a personalized advice or innovative financing solutions, don't hesitate to reach out to us at Moonshine Capital. Until our next episode, keep pushing boundaries of what's possible with alternative financing. Here's to your financial success and growth.